Hey guys, this is Rudy coming at you live from Palm Beach in Florida. Today, I want to talk about a rule. There are a whole variety of different rules and things that we have to comply with and adhere with. And as you've probably figured out by now, I pretty much break every rule I can, legally that is, so I don't get into trouble. But yeah, I'm not really one for following rules, but when I see people setting up a rule, I'd like to dive into it and kind of take a look and see what's going on here. This one particularly is for the old fossils like me, right? Because what I want to do specifically is talk a little bit about retirement. And more specifically, I want to talk about the 4% rule. Now, as I said right from the start, whenever anyone makes a rule, my first inclination is to figure out how I can break that rule. But that's just my DNA. So don't punish me for that one. Anyway, the 4% rule relates to retirees, and the objective behind it, or behind this video per se, is that we see questions asked all the time. So pretty much anyone on any website that goes into a financial type website. So in this particular example, I went into Yahoo Finance, and there's always these questions, right? So this one at the top here says, we're 56 with $1.2 million in investments and savings. Can we afford to withdraw 40 to 60 to $80,000 per year? And then the one below that says, ask an advisor, my retirement savings were wiped out. And the next one says, the equivalent of the 1/3 of my monthly retirement contributions get eaten up by. And this one says, I'm 60 and I want to withdraw $250,000 from my 401k to pay off the mortgage. Well, that's a problem. If you're 60 and you want to retire, why do you still have a mortgage? Perhaps you should take care of the debt first. But that's a separate topic. My point here is that the concept of people asking, how long will my money last in retirement? Or how long, if I withdraw X number of dollars per month or whatever, will my money last before it runs out? And hopefully your money doesn't run out while you're still going to be alive for another 20 years or so, because otherwise, Houston, we have a problem. Now, looking at the sort of advertisements that come up on these pages, when you type for any information related to a financial advisor, wealth management firm, etc., you get the typical feedback from a website like Google and one of your trusted, reliable partner sites like Google. And you'll see some sponsored content like this one that I've outlined here in a little green box that says, Morgan Stanley, are you ready to retire? Come back to the other box in a minute. And just below that, how long will my money last in retirement? And then right beneath that nerd wallet says, number one, the 4% rule. This approach is simple. You take out 4% of your savings, et cetera, et cetera. I'll get into that in just a minute. Now, why is it that people are basically focused on how long my money will last in retirement? And the simple answer to that is because nobody wants to run out of savings or money when you are retired and no longer earning money. Well, that in itself is a problem because it's a little bit more nuanced than that, because what exactly is retirement? Now, for folks like me who are kind of semi-retired, I work every single day. Retirement just means I don't have a cubicle that I go to every single day, but I still keep myself busy and I do all kinds of stuff, including fun stuff like this video that I'm making here. But people are always asking this question. Well, one of the reasons why the 4% rule is so popular is because financial advisors and wealth managers like to tell you that you can withdraw, for example, 4% of your savings on a monthly basis for the rest of your life or for the next 20 years or whatever the case might be. And the reason why financial advisors and wealth managers frequently do this is because by doing continuous little transactions in your account, including disbursements to your personal checkings account or savings account, almost like earning a salary, they can charge fees and they can make money all along the way, and your money will be depleted much faster than what you could possibly even realize. Just a little while ago, I had a client, and this client was actually withdrawing $800 a month from her Wells Fargo wealth management account, and the balance was actually draining quite quickly. Now, if you do the math, you say $800 per month times 12 months is $9,600, so let's call it $10,000 per year. Then in theory, you could say, well, if I started the year with whatever, 200,000, 500,000, 1 million, whatever the case might be, I'm drawing down $10,000 per year, approximately, just to make it a round number. So if I use the example, and let's just go with the middle number and say $500,000 was my opening balance, I withdrew $10,000, and at the end of the year, I have $460,000 left in my account. Why is that, Mr. Roxy? Well, the first reason is you withdrew $10,000. The second reason is they're mismanaging your account, because they're not only mismanaging your wealth or your assets, but in addition to that, they might be charging you fees along the way as well. So they're doing bad financial planning, bad financial management, charging you fees all the while and giving you $800 per month, causing you to be prompted to ask the question, how long will my money last before it all runs out? Let me go back to the presentation here and say, why is it that they do that? Well, in this big green block on the right-hand side here, I just extracted from Glassdoor the total pay range for portfolio manager at Morgan Stanley. And I'm picking it on Morgan Stanley, I'm just using this as an example, is between $144,000 and $242,000 per year. So, around $12,000 to $24,000 per month, including base pay or base salary and additional pay. They need to make that money and earn that money somehow. One way is by attracting preferably high net worth clients who have a lot of money that they can sock away into a wealth management account. And then secondly, the wealth manager's job is not only to manage the money or mismanage the money, but also make sure that they earn as much fees as they can possibly get their hands on. So if I go to NerdWallet and I take a quick look here and I say, how long will your savings last? And here I'm just using the defaults. The annual investment return 6%, and the reason why they use 6% is because the Dow has returned an average of 6% for more than 100 years on average. Some years it was up 30%, and in other years it was down 20, 30, 40%. So that's an awful number to use, the average, but the fact of the matter is, mathematically speaking, it's 6% per year for more than 100 years. The estimated tax rate here is 20%. We can assume that people in retirement might need less cash in their pockets on an ongoing basis, so the tax rate might be a little bit lower. I don't know what it is in your jurisdiction, but I'm just using the default here. Then it says, how much money do you currently have saved? And the answer is $250,000. And this particular person, this is a fictitious person, wants to withdraw $2,000 per month. Well, their money will last for 14 years based on NerdWallet's calculator. Now, if this person is 60 years old and they get to 74, they are effectively out of cash. They have no more savings left over because they withdrew it all at a rate of $2,000 per month, and it's all gone. And now we have a problem, because if this 74-year-old person were to live until the age of 104, and believe it or not, I have some clients whose family members just recently passed on and left us, and one particular person was actually literally 104 years old. So a wonderful innings, but not a good story if you retired at 60 or 65, hoping that your money would last you for the rest of your life, and then you live for another 40 years. So this doesn't work out too well. But I'm going to play with those numbers in just a minute, and we'll take a look and see what happens. Now, this is what the smart people, right? So in other words, not me, the intelligent people in the financial services industry show you when you want to set up a portfolio based on your age. And this is just an example. Obviously, it's going to vary by individual. So I just snapped this from Charles Schwab's website, and it says, if you are in a moderate type of risk environment between the ages of 60 and 69, then these are the types of holdings you want to have. So 60% stock, 35% bonds, 5% cash. That would be kind of your spread or your mix. But if you're already 80 years or older than that, you may want to cut down on your stocks and have maybe just 20% stocks and then 50% in bonds. There are reasons why they do that as well. And this is purely mostly related to risk mitigation for the client, and secondly, fees, because they make fees on an ongoing basis. So let's play with these numbers just a little bit. Let's assume that you can generate an annual return. Instead of 6%, we do 10%, and your tax rate is still 20%. I've left it $250,000 as it was, and we're still drawing a monthly distribution of $2,000. Now it's going to last for 22 years. So if my retiree, let's say, for instance, worked until the age of 60 or 65, and they retired with $250,000 and did a distribution monthly on a monthly basis of $2,000, they would be able to get to the age of around 87 or so before they will, in theory, run out of cash. Now, of course, using my earlier example, they may live another 20 years, which means, Houston, we have a problem. So let's change the numbers just a little bit. And I say, what if you could, and it's very difficult, generate an annual return of 15%? That's not easy to achieve, especially not with the mix of assets that the previous slide showed from Schwab, where they're basically saying, have some stocks, have some bonds, and some cash. you're not going to generate 15% with a portfolio mix like that. But now I've also increased the tax rate to 30%, left the $250,000 in the 2000 the same, and the money will ask, well, you have plenty, right? But I'm assuming a 15% ROI and a 30% tax. Now, let me just pause there for a minute. If you think of the ROI, so the amount of revenue that you can generate from your portfolio, regardless of the balance, if you put it 100% into stock, right? So we have no cash, no bonds, no nothing else, it's just 100% into stock. And you literally, just to make it really easy, buy the Dow, all right? So we say the Dow is an index of 30 of America's top companies. And let's say, for instance, you chose from that basket, and hopefully you chose well, and you chose like 10 Dow stocks or 15 Dow stocks, so half the index, or you even bought the entire index as DIA, which is an ETF that invests in the Dow. Then you can say, well, I can expect realistically to make 6% per year return on investment. Now, of course, many of those stocks pay a dividend as well. So if the stock market actually goes up on average, and I said an average number is not a good number to use because sometimes you might be down 30%, sometimes you might be up 30%, right? But let's say, for instance, just over an average period that is several decades, so 20, 30 years, you generate 6% per year in terms of stock appreciation. And in addition to that, you earn 3 or 4% in dividends. Now you're already up to 14%, right? But that doesn't, up to 10%, but that doesn't get you to 14, 15%, which is what I was talking about just a minute ago. So how on earth can you get to that level of earnings? So if you look at this particular example here, and I'm just using one equity, Alliance Resource Partners, and this is a limited partnership, so it's not suitable for everybody. And in some jurisdictions, you don't even want to hold Alliance Resource Partners because you get taxed to the hilt. In fact, in some jurisdictions, the government will take half of your dividend. But Alliance Resource Partners pays a dividend right at the bottom in the middle of the screen of almost 15%. So now if I can get a stock appreciation of just a percentage or two, or otherwise if I'm in a heavy tax jurisdiction and the government takes half of my dividend, I'm still up 7%. So if I can get another 3%, or maybe even if I'm lucky, 6% stock appreciation, I'm getting to 13 and close to 15% per year. But it's not easy, and you probably don't want to put all your money in Alliance Resource Partners, especially because Alliance Resource Partners is a coal company, and coal is filthy and dirty, and is going to destroy the environment, remember? So what exactly is this 4% rule? It's a rule of thumb used by retirees to decide how much they should withdraw from their retirement funds every year. Now, I'm sure the mathematician who came up with this intended it to be put to good use, and you could arguably say, well, the 4% rule is probably a reasonable rule for the majority of people who want to earn a steady income stream while maintaining an adequate overall balance for future years. Experts are divided. Now, I am not an expert, so therefore I'm not divided at all. But what I will do is I will spend just a second or so and tell you what I do. So I don't have any income. So I don't have an income that is taxable, but I do have income from investments, right? So when I say I don't have any income, I mean I don't have a job and I don't earn a salary. No one's paying me a contract fee. I don't have any of that type of income. In the United States, we call salaried income W-2 income, and we call contractor earned income 1099 income. I do have little bits of 1099 income, but it's irrelevant or insignificant to this discussion. But basically what I'm saying is I don't necessarily pay income tax. However, I also have no desire to get a monthly check from Morgan Stanley or Wells Fargo or whatever, Merrill Lynch, etc., as a salary. Most people are so programmed because there's very, very few things as addictive as a monthly salary check, right? So many people work for 40 years or more, go into retirement, and then still expect to get a monthly distribution paid from their savings on an ongoing basis. Now, the reason why they do that is primarily because they have been programmed to do that. So what do? I actually only take a distribution when I need to take a distribution. Sometimes I will take into consideration my total costs for an entire year, and I will say, and let's just make it a really easy number. Let's say, for instance, I need to spend $2,000 per month using my NerdWallet calculator example. So sometimes I will look at my ongoing expenses, and $2,000 per month is $24,000 per year, and I'll make a one-time withdrawal of $24,000, and that should basically pay my out-of-pocket expenses for the whole year. whatever that number is for you or your particular circumstances, that's kind of how I work it, right? So it doesn't matter what the number is, even if it's $240,000, I don't want $20,000 per month, because if I have $20,000 per month, number one, I might just spend it. Or number two, if I don't spend it, then at the end of the year, let's say, for instance, I withdrew $20,000 per month, that's $240,000 for the year, and I only spent $200,000 only, right? Then I'm left with $40,000 I didn't spend, but I withdrew it from my investment portfolio. Now, why would I do that, right? So I'd rather reverse engineer that equation and say, how much do I need for all my basic out-of-pocket expenses for the whole year? And then I withdraw that. If I have some kind of an extraordinary expense along the way during the year, for instance, let's say I buy another car, or maybe I want to, go on vacation and fly somewhere, and that's not included in my basic out-of-pocket expenses that I pay on an ongoing basis, I'll make an additional withdrawal. But I'll only draw the money if I need to draw the money, which means I am not taking a regular distribution on a monthly basis. And in addition to that, I'm also not paying ongoing fees to a financial advisor or a wealth management firm in order for them to process and send me a check or send me a deposit into my bank account every month. Many, including the creator of the rule, say that 5% is a better rule for all but the worst case scenario, and some caution and say 3% may be safer in the current interest rate conditions. I espouse to neither of those, not even, or neither of the three of them, 3%, 4%, or 5%. I don't subscribe to any of that. I've just explained to you what it is and how I do it myself. This is the other problem that I have with the rule, right? So they say this is the rule of 25, which is the 4% rule in terms of withdrawal. It says basically, if you want to withdraw, now let's take this middle range here and say, I need $5,000 a month as income, that's $60,000. Then they are telling me, in order to generate an income of $60,000 or $5,000 per month, I need to have $1.5 million invested. Very few American people have $1.5 million invested. So very few American people will be able to get to $5,000 per month from their investments. They may be able to derive $5,000 a month in a different way. For instance, if they have some kind of social security or some kind of a pension, or they work part-time, for instance, at the Home Depot or something like that. There are many things that you can do to generate some cash. And then perhaps instead of needing $1.5 million, you only need the equivalent of like $750, which means you're only withdrawing $2,500 per month from your investments. And you are actually, while you are physically able to do so, working to generate the additional 50% that you are not withdrawing. So a couple of pros and cons before I wrap it up here. So the 4% rule cannot guarantee the retirement savings will last for the remainder of a life. And that's the biggest problem with the rule, right? So I used the examples right at the start of the video and said, if you retired, whatever retirement means, at the age of 65, and your investments only lasted you, 14 years or whatever the case might be, and now you are 79 or 80 years old and you're out of money and you're still going to live for another 20 years, you have a huge problem. So these rules are meant to be broken, and you probably should very, very carefully work with your financial advisor to figure out whether this is the right thing for you to do or not. A severe or protracted market downturn, of course, we always view everything from the point of view of if a comet strikes Earth, right? Worst case scenario first, and then hopefully it's not as bad as what you had imagined. A splurge on major purchases, I mentioned that, for instance, if I want to buy another car or I want to take a holiday or something like that. The benefits, it's simple to follow, and it provides a predictable, steady income. Like I said, there are very few things as predictable as a monthly salary check. Now, the problem I have with the whole concept of what I'm sharing with you is sometimes we ask ourselves the wrong question, and then when we come up with an answer, it's automatically the wrong answer. So if you ask the wrong question and get three different scenarios, and all of them are three best case scenarios for solving your incorrect question, then all your best practices and best results for your question that you just answered are also effectively incorrect. The first big question is, what is retirement? Now, I explained a couple of times what retirement might mean, just not only for me, but also for a fictitious person who might need $5,000 per month in retirement. The first question you need to answer there is, why do I need $5,000 per month in retirement? Because maybe you actually don't need $5,000. You need $3,500, $3,500 pays all your out-of-pocket expenses, and the other $1,500 is just play money. Maybe you can cut back on some of that play money and automatically then you don't need $5,000 per month. But I also made mention a couple of times about the incorrect question. What exactly is the question that you are asking? If you are asking, how long will my money last if I withdraw 4% per year? Then that effectively, using my nuance, is the wrong question to ask, because what you should actually ask is, how much money do I need on an ongoing basis to pay my out-of-pocket expenses? And then can I afford to pay any additional expenses on top of that? Yes or no? And then you can start asking additional questions like, what is the best mix for my portfolio to match my risk mitigation or my personal risk profile? How much money do I have invested? How long will it last? All that kind of stuff, right? But if you ask the incorrect question, then you end up with a situation like, for instance, where we had a vaccine, which effectively didn't work necessarily as advertised. And instead of changing the vaccine, they changed the definition of being vaccinated, right? So there are things like that where we need to pay very, very careful attention to what the actual question is and make sure that when we try to answer the question, we answer the right question. The 4% rule is great for people who want to continue earning a regular monthly salary, right? Do you really need a regular monthly salary when you are in retirement, whatever that means to you? How risk averse are you? And other things to keep in mind is what currently is my general health, my age, am I active? What is my diet? What is my family situation? There are many things that come into play that you want to take into consideration before you just allow someone to ascribe some kind of a fictitious rule to your life savings and then informs you as to how you should be spending it or not, right? Not an easy question to answer, but it's a very, very critical question for people to get to grips with as they get older, as we all get older, because there's nothing you can do about that. And then when you have some savings built up, you want to preserve that wealth as best you can and make sure that you get the best advice you possibly can for your particular situation. So on that note, thanks for watching. Take care. Good luck. Bye-bye.